great to have you here today, Peter. I'll be
Yep, same
sharing
here. Thanks for having me.
Yeah, what a great time to have you. If the Fed is not data dependent, but S&P dependent, and we're making new highs, what are your expectations from them? Since that's your statement, buddy.
I don't expect much tomorrow. I mean, the Fed has proven to, as yes, S&P dependent, but right now all they're focused on is getting through the next couple months and see how the vaccine rollout goes. They'll probably get softball questions, but I do think as the months progress and this vaccine does get further rolled out, that there's going to be pressure on them to start a tapering discussion at some point. Interestingly, this morning, the head of the central bank in the Czech Republic actually talked about the possibility of raising interest rates up to 2 times by the end of the year, which is actually prudent central banking, because the reason why central banks did what they did in 2020 was because of COVID, and you'd have to, the proper thing to do would be, as COVID goes away,
unwind it.
But the Fed is obviously taking a different tack by telling us that they're not raising rates until 2024. But the bond market is not just going to sit there and do nothing. We've already seen a rise in rates with the 10-year above 1%. And getting
it's
as high
pulling
as,
right back to that level, Peter. So do you think this was a turn that's long lasting?
I think rates on the long end are going much higher. I think people will be surprised at where they go. I see in a lot of different areas of the economy, both statistically and anecdotally, higher inflation on the good side. We're seeing spikes in transportation costs. We're seeing major supply chain disruptions. We're seeing now increases in semiconductor prices because they can't make enough to satisfy at least the auto industry. So we have goods inflation on our hands, and once it's joined with services inflation, when people start getting back to their normal lives with COVID, once rents, which is a key component of CPI, start to inflect higher again to join what we're seeing in the home price market, where S&P Core Logic just now said that in November, home prices rose 9.5% year over year. That's some serious heady inflation. And that is a price gain that is more than offsetting the benefits of lower mortgage rates. And this is as the Fed owns about a third of the mortgage-backed security market. So I would hope that maybe some reporters can ask the Fed, why are you still buying MBS when we're now seeing 9.5% type home price increases? So inflation is here. And I think that's why we've seen this rise in inflation expectations within the TIPS market. We've seen a pretty good rise in commodity prices across the board. Obviously, gold is near a record high. We've seen energy prices get back above 50. We're seeing corn, soybean, wheat prices spike. We're seeing copper prices spike. So
you feel like when you started talking about this, Peter, probably 6 months ago. And now you know what everyone is. And plus we've had, this big bull run in grains, and metals have been a little bit more sideways, and energy has been pretty resilient. Are you starting to think that maybe you have a little bit too much company on this narrative right now?
Yeah, it's definitely gaining some consensus. I agree, but I see that inflation takes time to embed itself, and it'll take some time to flame out. And I think this is just the beginning. But I think people will be surprised at where inflation goes. I think people will be surprised when they start seeing 3% plus year-over-year CPI gains, because that's where I think we're going. And I think that is going to be highly disruptive to the world's bond markets if that happens, and it's going to possibly force the hands of central banks. Central banks believe that they're in complete control. They believe that that the current low inflation statistics measured by F.A.C.E, that they have license to do what they want to do, and they can shift policy when they decide. Like they can arrogantly tell us where they want interest rates to be and when. But if the bond market starts to revolt because inflation is rising, then the Fed loses some of that license, and I think
So,
that's going to be the case
do you
this year.
think the vigilantes are going to make a reappearance like Phoenix rising from the ashes? You think they're already in the market, and they're part of this decline? I'm looking at TLT right here, Peter, and you know, um, since the Fed came in during COVID, we're mainly moving sideways, but it almost looks like there could be one more run in the bond market to the upside. Could we have just a little air pocket if, say, there is, even though we have vaccines, possibly because of variants and what people are doing in Europe, if we could have another lockdown here in the US, do you think Biden will do it?
No, we're not having another lockdown. In fact,
Okay.
California yesterday said that they're reopening. Chicago
Yeah.
last week said that they're reopening indoor dining. Lockdowns are over.
Okay. Okay.
Everyone's looking towards reopening. Everyone's looking to. I mean, even Andrew Cuomo, who has killed a lot of businesses, along with people, unfortunately, in nursing homes, said a few weeks ago that we need to reopen these businesses, or else we're not going to be businesses to reopen.
Okay. All right. So, pretty optimistic tone. How are you deploying capital right now, Peter?
Well,
In the markets
optimistic
with
tone in the sense that I think that we're going to get this vaccine right over the next couple of months, and that the second half of the year is going to see a big normalization on the economy and our living, our lifestyles
okay,
in terms of
but
going
it's going to
out and about.
cost us.
Yes, because it's going to cost us in higher inflation, a weaker dollar, higher interest rates, and a reset on very extended market multiples.
Okay. So, what kind of reset are you thinking here, Peter, on market multiples? Where are we now, and what could we pull back to?
Well,
As
the market right now, as of today's opening, I mean, we're going to be trading at about 23 times earnings. So you get a rise in interest rates,
right,
maybe we'll still see $170 of earnings per share, but maybe that multiple is 18 instead of 23. I don't know if that's going to happen, but if you put an 18 multiple on $170, that's an S&P that's closer to 3,000 without any change in earnings. So I think getting the stock market right this year is going to be more getting the PE ratio right. I think it's an easier call to say with the vaccine that earnings are going to get better, the economy is going to get better. But tell me where the PE multiple will be, and I'll tell you where the market will go. I think it's hard to think that the PE multiple is not going to contract if I am right on inflation and long-term interest rates.
okay. So let me ask you about some of the other phenomena that aren't as, are probably part of the same symptom. Penny stock volume through the roof. Everyone's talking about GameStop. This type of price action, pretty euphoric out there. Have been euphoric, and that hasn't put a dent in anything. Um, does that tell you that we're, within 5% of a high? But are you looking for what type of correction to get the PEs back down to those levels? Would it take 10, 20% from wherever the high comes in?
Well, euphoric markets, which, as you say, we are clearly in, defined by the option activity, defined by the investors' intelligence that has had bulls above 60 and bears in the mid-teens, and the Citi Panic Euphoria Index, where the threshold of euphoria is 0.4, and 2 weeks ago we printed 2, and last week we printed almost 1.9. But euphoric markets and a speculative mania doesn't matter until it does, but it always does. And markets don't correct by going sideways; they correct by going down. It's just a matter of getting that timing right. But we're in a speculative phase that only happens every once in a while in the history of markets, but we're in one of them now. And for those that were in markets in the late 1990s, this is definitely a reminder. Most people trading a lot of these stocks like GameStop and Bed Bath and Beyond and others weren't around in the late 90s, and so they don't have that muscle memory.
Okay. All right. So maybe the Fed might mark this short-term high. I mean, if we know what's happening with this kind of mania, don't you think the Fed has any trepidation about malinvestments? I mean, especially, mainly highly speculative option buying and penny stock buying. What do you think they're thinking about that? That's fine because it's adding liquidity to households, or
Yeah, they don't seem to be worried about it. I mean, even Powell in his last meeting was asked, "Are you worried about market multiples?" And he said that they're essentially substantiated by the low rates. So we have a bond. So we have a bond bubble, and he's saying that we don't have a stock bubble because we have the bond bubble. It's I think I hope that they see it, but they're afraid of markets. They've for decades have been afraid of markets. The markets are their master. And when you hear about, oh, we don't want to repeat the taper tantrum, well, that's because they're afraid of the markets. And as long as they're afraid of the markets, they're going to be afraid to disrupt that. But now they're reaching a point where they've created another epic bubble again. And I don't know how they're going to extrapolate themselves. I mentioned earlier this 9.5% increase in home prices. I mean, this is not healthy behavior.
Yeah, with the housing stock at, I believe, historic lows. So,
well, the existing home sale number, yes, inventories are very low. Inventories always fall in November, December because of the holidays. But yeah,
okay.
Inventories are still very low.
So you know how we could increase supply, Peter? How about if there was some hedge funds that are not positioned well, and they bought up a lot of supply in 2008, 2000 through 2010, turned it into a yielding investment. Maybe they have to put some supply back out on the market if there was a run on their assets or some negative performance. But didn't they buy up, like maybe 10, 20% of all the foreclosed properties out there?
Yeah, they were definitely influenced. I mean, that's the chase for yield.
Yeah.
Now priced out the first-time home buyer because they're getting bid out by private equity and bid out by people that aren't first-time buyers that have equity in their homes and money for down payment. But that first-time home buyer is the one getting screwed by this.
Right. And also, I've heard, Peter, can you verify it, that a lot of people are having, even with all this appreciation, and then some people with their work have run into trouble where they're not making as much, but the banks are very reluctant to give equity loans, even though there's huge appreciation, that homeowners used to be able to tap into that ATM machine much easier than now. Is that true?
Banks have tightened lending standards across the board. And it's not just in mortgage, it's in real estate, it's in commercial and industrial loans, that all this easy money has not seeped into an easing of lending standards. It's been the exact opposite.
So isn't that deflationary?
Yeah, on paper it is.
Okay.
But if I can't get a container from Asia because it's being used someplace else, if I'm having to pay double-digit increases to get a truck to ship my goods from point A to point B, it doesn't matter. We have inflation right now on the goods side because of the crimp of the supply side.
Right.
We have oil above 50 because we've had a crimp on the supply side. You don't hear about oil SPACs or copper SPACs or nickel SPACs or corn SPACs. So we've had a big impact on the supply side that is leading to the inflation that we're seeing. But when you do get this vaccine and people start behaving again as they did pre-COVID, then you mix these supply constraints that are not getting resolved anytime soon with a pickup in demand, and that's going to be a perfect cocktail for higher inflation.
Okay, so we could, like the 70s, we could have higher inflation and not great performance in other financial assets like equities.
That's correct.
And bonds are really going to be the weakest, the place you don't want to be because of a falling dollar and higher prices, you're going to have to pay people more money for them to hold your paper. Is that what you're
I
saying?
believe so.
Okay.
And to the dollar comment, the dollar also being weighed down by the exploding U.S. debts and deficits. That if that weakness does continue in the dollar, will then further this inflation theme.
Any comment, Peter, on Yellen being Secretary of the Treasurer, and I believe she said we won't see a financial crisis in our lifetimes?
Yeah, she said that a few years ago when she was at the Fed. I think Yellen at the Treasury, in terms of policy, is really irrelevant. She's not she can't pass legislation, and she's not at the Fed. So she's just basically a salesman, just as every Treasury Secretary is just a salesman for their president on the economic and fiscal side, nothing more.
Okay. I think she made comments about not wanting to use a weak dollar for trade competitiveness. Like,
Well,
she has a choice anyway.
She has to say that because
Right.
we just a few months ago accused others of manipulating their currency. We can't have the next head of the Treasury admitting that they're manipulating their currency.
Okay. Peter, anything else that's on your radar that you want to share with us today? I mean, I think I've asked you about everything. Your view on whether or not you think Biden could be successful in getting his 1.9 trillion COVID relief package through Congress?
He will not be successful getting 1.9 through. He will get something through, probably a trillion and a half. But regardless, it's still another extraordinary amount of money after the 900 billion that was just signed into law on December 27th. So there's this belief that that there's no consequences to all this spending, but we're already seeing it in a weaker dollar. And a weaker dollar reduces one's purchasing power. Also, a lot of this spending is not productive. It's not like at the end of the day, after all this spending, we're going to have a brand new airport or a brand new bridge or something new. A lot of this is just transferred payments and filling holes. So we're spending trillions of dollars of unproductive of spending that is going to leave us nothing at the end of the day.
That word, when's that come home to roost?
Well, it's already beginning to in the weaker dollar.
Okay.
It's already beginning to in the rise in inflation expectations and the rise in long-term interest rates. Even though long-term interest rates are low, obviously, all you need is a small increase in interest rates on a very high base of debt, and those numbers really matter.
Yeah, I mean, the 10-year was 0.5 bips and got to about 118, and now it's hovering. You think this 1% psychological level in the 10-year is important?
I mean, purely psychological. I mean, I get asked the question all the time: is at what level of the 10-year yield does it matter for markets? And I don't necessarily know the answer. I don't know if it's 1.25, 1.5, 1.75. I just know that if the trajectory continues higher, at some point something will break.
Okay, and here is that longer term picture, Peter. If you look at the weekly, looks like, here's the 10-year. 1.5 going to matter, 2% going to matter, 3%. I guess it also depends on how quickly it happens, right?
Right. I mean, the move above 1 was pretty rapid. Obviously, we're resting
this candle.
Here. Yeah. But I think in the next couple of months, when the vaccine gets further rolled out, that long-term rise in rates is going to continue.
Any reservations for yourself personally in taking the vaccine?
No, none whatsoever.
You're in a hurry. You're in a hurry to do it. Okay.
I look forward to getting it.
Okay, great to hear that, Peter. And thank you so much for coming in here today. Everyone, you could follow Peter on his website at the book report. Here it is. Not the kind you used to write in grade school, but
thank you, Dale.
Great content.
Thanks.
Peter, appreciate you being here. Good hunting,
thanks for having me. Take
All
care.
Right.
See you soon.
Okay.
All right, bye-bye.
Peter Boockvar, everyone. Find him on Twitter at pboockvar. And that's going to be a wrap. Turnaround Tuesday, everyone. I hope everyone has a great day And remember, don't just count your pips, count your blessings. And we'll see you tomorrow. Adios. You're very welcome, everyone.